What if I told you that the economic system you've known your entire life is about to fundamentally transform? And what if I also told you that the people preparing for this shift are already making decisions today that will determine their financial future for the next decade? Well, in the next 20 minutes, I'm going to show you exactly what's coming, when it's likely to happen, and most importantly, what you need to do about it right now. But here's the thing. This isn't doom and gloom speculation. This is based on historical patterns, demographic data, and the decisions of the world's most powerful financial institutions that are already being made behind closed doors. So if you want to understand what's really happening with your money, your investments, and your family's financial security, you need to watch this entire video because the information I'm about to share could literally change the trajectory of your life. Let's dive in. The global economy stands at an unprecedented crossroads, and for the first time in modern history, we're witnessing the convergence of multiple destabilizing forces, all happening simultaneously. This is not hyperbole or sensationalism. This is measurable economic reality that even mainstream financial institutions are now openly discussing in their quarterly earnings calls and strategy sessions. First, let's talk about debt. Global debt levels have reached an astronomical $313 trillion. To put that in perspective, that's over 3 times the entire global GDP. This isn't just government debt, it's corporate debt, household debt, and financial system debt all combined into one massive bubble. The United States alone has a national debt exceeding $34 trillion, and unlike the private sector, governments can't declare bankruptcy. They can only debase their currency, which is exactly what's been happening. When you print trillions of dollars in stimulus without a corresponding increase in productive capacity, you don't create wealth. You dilute the existing money supply and create inflation. Second, we have the demographic cliff. Birth rates across developed nations have plummeted below replacement levels. In Japan, Germany, Italy, and increasingly in the United States, there are now fewer young workers entering the workforce than retirees leaving it. This creates a fundamental problem for any economy built on growth models that rely on population expansion. When you have fewer working-age people supporting a growing number of retirees, pension systems start to collapse. This is the pension crisis that's coming, and it's not theoretical, it's arithmetic. Third, we have technological disruption on a scale never before witnessed. Artificial intelligence, automation, and robotics are eliminating entire job categories in real time. The difference between this wave and previous technological revolutions is the speed and scope. Previous transitions took decades. This one is happening in years. Companies are already announcing massive layoffs to accelerate their AI implementation, and we're only in the early stages of this transformation. Fourth, we have geopolitical fragmentation. The dollar-based system that's governed global trade since 1944 is being actively challenged by alternative payment systems, bilateral trade agreements, and the development of competing digital currencies. China, Russia, India, and a coalition of emerging markets are building trade infrastructure that deliberately sidesteps US dollar dominance. This isn't going to collapse the dollar overnight, but it's creating structural weakness in the system that's been the foundation of American economic power. Finally, we have the energy transition paradox. The shift away from fossil fuels is simultaneously driving energy inflation while creating supply chain vulnerabilities. Rare earth minerals, lithium, cobalt, and other critical materials are now geopolitical leverage points. Countries that control these resources are extracting higher prices, and the energy transition costs are being passed down through the entire economy in ways that nobody anticipated during the climate movement's early phases. When you combine these 5 forces, unsustainable debt levels, demographic collapse in developed nations, AI-driven job displacement, geopolitical realignment, and energy transition chaos, you don't get a normal recession. You get what the World Economic Forum, the International Monetary Fund, and major central banks are now calling a transition period, or reset. They're not using the word collapse, but they're clearly preparing for a fundamental restructuring of how the global economy functions. If you want to understand what's coming, you need to study what's happened before. Economic resets aren't new phenomena. They happen regularly throughout history, and each one follows a surprisingly consistent pattern that we can use to prepare for what's ahead. Look back at the 1970s stagflation. The government had overstimulated the economy, inflation reached double digits, and suddenly the comfortable post-war boom collapsed. People who didn't see it coming were devastated. Their savings were destroyed by inflation. Their investments lost real value, and their ability to purchase basic goods was severely compromised. But people who understood what was happening, who could see the pattern, they took specific actions. They bought commodities. They invested in real assets. They shifted their portfolios out of bonds and into inflation hedges. Many of them actually became wealthier during the crisis because they were swimming against the current while everyone else was being swept along. Or look at 2008. The housing bubble was obvious to anyone paying attention. The debt structures underlying the financial system were absurd. But most people didn't want to see it. They were making money in real estate. They were comfortable. And the idea that the entire system could come crashing down seemed impossible. But to the people who actually understood the pattern, people like Michael Burry and the investors documented in The Big Short, it wasn't a surprise at all. It was inevitable. And the people who prepared, they made fortunes while everyone else lost their homes and retirement accounts. The 1944 Bretton Woods system created a framework for global economic organization that worked remarkably well for 3 decades. But by the 1970s, it was clear that the system had fundamental flaws. The US couldn't maintain the gold standard while simultaneously engaging in expensive foreign wars and massive domestic spending. Something had to give. When it did, in 1971, everyone who understood the pattern had already repositioned their assets. Gold, which had been artificially suppressed, tripled in price within a decade. This is the crucial insight. Major economic resets don't happen suddenly. They're not black swan events that nobody could have predicted. They're the inevitable conclusion of structural imbalances that build up over years or decades. The warning signs are always visible to anyone willing to look at the data. The reason most people get blindsided is not because the reset was unpredictable. It's because acknowledging the problem would require them to make uncomfortable decisions in the present. It's psychologically easier to believe that everything will be fine than to accept that the entire system needs restructuring. So what's the pattern we should be looking at for this particular reset? First, we have the debt buildup phase, where governments and corporations take on more and more leverage, telling everyone that this time is different and that traditional economic limits don't apply. Then we have the inflation phase, where that debt starts to lose value and the currency begins to debase. Then we have the policy response phase, where governments try to control inflation but end up creating artificial constraints that destroy growth. Then comes the deleveraging phase, where debts must be written off or restructured, financial assets lose value, and existing wealth is redistributed. Finally, we have the rebuilding phase, where a new system emerges with different rules, different winners, and different investment opportunities. We're currently in the transition between the policy response phase and the deleveraging phase. The Federal Reserve and other central banks have hiked interest rates aggressively to combat inflation. But this interest rate regime has created a new set of problems. Zombie companies that can't service their debt, pension systems with massive underfunding shortfalls, and a commercial real estate sector that's on the verge of structural collapse. The reset isn't coming next year or in 5 years. The conditions for it are already here. We're living in it right now. The reset is starting. The most critical distinction between this economic reset and previous ones is the question of currency. For the first time in history, we're witnessing the deliberate construction of alternatives to the incumbent global reserve currency, while simultaneously experiencing structural weakness in that currency system itself. The US dollar has dominated global finance for 80 years. This dominance wasn't accidental. It was intentional, created at Bretton Woods, and maintained through the enormous economic and military power of the United States. For 80 years, any country that wanted to participate in global trade had to use dollars. Oil was priced in dollars. International loans were denominated in dollars. Central bank reserves were held in dollars. This system provided extraordinary benefits to the United States. It allowed the Federal Reserve to print dollars and have the world accept them as payment. It allowed the US to run massive trade deficits because everyone needed dollars. It was an imperial privilege disguised as an economic system. But empires don't last forever, and economic dominance is no exception. China, Russia, India, Brazil, and an increasingly large coalition of countries are now building payment systems that deliberately exclude the US dollar. The BRICS bloc is creating a separate payments infrastructure. China is internationalizing the yuan. Russia and China are trading in rubles and yuan instead of dollars. Iran and Venezuela are building cryptocurrencies. This isn't coordinated conspiracy, it's rational self-interest. Every country that doesn't want to be subject to US sanctions or monetary policy has an incentive to build alternatives. The significance here cannot be overstated. If the dollar loses even 20% of its current global reserve status, that represents a massive devaluation of the currency. The United States would lose the privilege that's been generating wealth transfers for decades. Other currencies would strengthen. Assets priced in other currencies would appreciate dramatically. And most importantly, the ability of the US government to print unlimited amounts of currency would be severely constrained because foreigners would no longer be willing to absorb those printed dollars. They'd have an alternative. For the first time since 1944, the US would have to function as a normal country with a normal currency rather than as the issuer of the global reserve currency. The reset in currency status doesn't necessarily mean the dollar collapses tomorrow. The transition could take 5 years or even a decade. But the trajectory is clear, and it's already in motion. What this means for your portfolio is that holding large amounts of dollar-denominated assets, especially bonds, becomes increasingly risky. As the dollar loses status, dollar bonds lose value. Real assets, land, commodities, companies that earn revenue in multiple currencies become more valuable. Gold, which serves as a currency that no country can print, becomes more valuable. Companies with pricing power and real earnings become more valuable. Stocks of companies that are pure financial engineering plays, without real underlying cash flows, become less valuable. This is fundamentally different from previous economic cycles. In the 2008 recession, cash and dollar bonds became more valuable because they were denominated in the incumbent reserve currency. In the currency reset scenario, cash and dollar bonds become less valuable specifically because they're denominated in the currency that's losing status. This is why the ultra-wealthy, the hedge fund managers with the deepest insights into financial markets are already moving into hard assets, commodities, and diversified currency positions. They understand that the rule of the game is changing. Furthermore, the reset is being accelerated by the development of digital currencies. Central banks worldwide are developing central bank digital currencies, or CBDCs, which would represent a complete transformation of how money functions. Instead of the current system where central banks create currency and commercial banks distribute it, in a CBDC system, the central bank could directly control every financial transaction. They could program currency to expire. They could prevent certain purchases. They could adjust interest rates on money itself and automatically apply them without the current banking system as intermediary. From a government perspective, this is incredibly attractive because it provides total monetary and financial control. From a citizen perspective, it's potentially terrifying because it eliminates financial privacy and creates unprecedented government control over individual economic activity. The window for this transition is narrowing rapidly. Once CBDCs are fully implemented, the nature of money itself changes, and you won't have the same options for protecting your wealth that you have today. People who prepare now, who move into assets outside of the digital fiat currency system, who establish alternative income streams not dependent on traditional employment, who develop hard skills that will be valuable in a restructured economy, those people will emerge from the reset in a stronger position. People who wait until it's obvious, until everyone is acknowledging the transformation, will be making their moves into already priced-in investments, and they'll be paying the highest prices for protection precisely when they need it most. When an economic reset occurs, the value stored in different asset categories doesn't just adjust, it fundamentally reallocates. Some assets become worthless, some become more valuable, and some emerge as entirely new categories. Understanding which assets will be on which side of this transition is the core of preparing for the reset. Let's start with the most obviously vulnerable asset: bonds, particularly government bonds. For the past 40 years, bonds have been a classic safe investment. Retirees put their life savings into bonds because they were supposedly risk-free. backed by the full faith and credit of the US government. But in a currency reset scenario, bonds become extraordinarily risky precisely because they're denominated in the currency that's being reset. If the dollar depreciates by 30% relative to other currencies and real assets, then a bond yielding 4% in dollars has just lost 30% of its real value. The 4% yield doesn't compensate for that loss. Governments and central banks know this is coming, which is why they're preparing bond markets for significant losses. They're already discussing financial repression, which is the euphemistic term for governments defaulting on their debt obligations through inflation and currency devaluation. Next, consider real estate. Conventional wisdom says real estate is always a good investment because they're not making more land. But real estate values are highly dependent on the monetary system. In the current system, cheap money has inflated property values far beyond their productive capacity. A piece of land might generate $50,000 in annual rental income, but it's valued at $2 million. Because money is cheap and investors are looking for yield anywhere they can find it. In a higher rate, lower money supply environment, that same property might be worth $500,000 because now it needs to generate a real return on capital without the artificial monetary stimulus. Real estate becomes more local, less mobile, and its value becomes more tied to its actual productive capacity rather than to monetary conditions. Urban real estate in declining cities becomes particularly vulnerable, while rural land with productive capacity, farmland, timberland, land with water rights, becomes more valuable. Equities are more complex because the stock market isn't a monolithic asset category. The S&P 500 includes companies with wildly different characteristics. At one end, you have financial engineering plays, companies that are valuable primarily because they can borrow money cheaply, use that money to buy back shares or acquire other companies, and create financial gains without any underlying increase in productivity. These companies are extremely vulnerable in a reset because their entire value proposition depends on cheap money and high multiples. At the other end, you have companies with real earnings, real cash flows, and real pricing power. Companies that generate value from actual products and services that people want. These companies will weather the reset much better. In fact, many of them will thrive because they'll have less competition when the financial engineering crowd gets eliminated. Then we have the assets that become dramatically more valuable. Hard assets, commodities, and real wealth generators. Gold and silver, which have been derided as relics by modern finance, are fundamentally valuable because they're scarce, they can't be printed, and they're universally recognized as stores of value. Throughout history, every time fiat currencies lose value, precious metals gain value. Every single time. It's not mystical, it's supply and demand. When the supply of currency increases and the supply of gold stays constant, the price of gold in that currency has to rise. The reset will be no exception. Similarly, commodities more broadly, oil, copper, lithium, rare earths, agricultural products, become more valuable because they're actually useful and their supply is constrained. Unlike financial assets, which can be created with a keystroke, you can't print more oil. But here's the crucial insight that most people miss. The most valuable asset in a reset scenario is neither stocks nor bonds, nor real estate nor commodities. It's production capacity and expertise. If you have the ability to produce something of value, whether that's a trade skill, a business that generates real cash flow, agricultural production, energy production, or manufacturing, that becomes extraordinarily valuable because the reset creates massive shortages in productive capacity. Companies and individuals with excess production capacity can essentially set their own prices because there's no alternative supply. During the last major reset, 2008-2009, people with construction skills, HVAC expertise, electrical knowledge, and other trade skills actually made more money than they did before the crisis, because there was suddenly a massive shortage of people who could actually fix and build things. The financial engineers lost money, but the plumbers made a fortune. Finally, there's the most underestimated asset: geographic and political diversification. People who have assets, income, and possibly residency in multiple countries are protected because they're not subject to the failure of any single country's currency or political system. This is why the ultra-wealthy have always invested internationally, held multiple passports, and maintained properties in different jurisdictions. If the US dollar implodes but you also have assets in Singapore, Switzerland, and Canada, you're protected. If government controls become oppressive in one country, you have options. Geographic diversification isn't paranoia. It's insurance against concentrated risk. In a reset scenario, this insurance becomes extraordinarily valuable. The reset is essentially a wealth transfer mechanism, where assets that depend on a specific monetary structure lose value and are transferred to assets that have intrinsic value, independent of that structure. The mechanism of transfer works through currency devaluation and changing interest rates. If you're still holding assets priced for the old system when the new system arrives, you'll be paying the transfer in the form of losses. If you've already shifted into assets that will be valuable in the new system, you'll be on the receiving end of that transfer. The question everyone asks is, when is this going to happen? And the honest answer is that the reset is already happening. It's not an event at a specific moment in time. It's a process that's already underway and will accelerate over the next several years. But understanding the likely acceleration points can help you prepare. We're currently in 2025, and the structural conditions for the reset are already fully in place. US national debt is unsustainable on any reasonable timeline. The Federal Reserve is caught between two terrible options: continue raising rates and crash the economy, or start cutting rates and watch the currency devalue. Interest rate futures markets are already pricing in multiple rate cuts starting in 2025, which means the consensus among traders who have real money on the line is that the Fed is going to capitulate to the pressure and move toward monetary easing. When that happens, inflation will return, the currency will come under pressure, and assets will begin repricing. The 2026-2027 timeframe is particularly significant because that's when commercial real estate debt begins maturing on a massive scale. Hundreds of billions in commercial real estate mortgages that were locked in at low rates are coming due, and they need to be refinanced at much higher rates. Many properties can't support the higher interest rate payments based on their current cash flows. This is going to force a wave of defaults, foreclosures, and restructurings in the commercial real estate market. When major asset categories start declining in value, it triggers forced selling as companies and funds need to raise cash, which then cascades into other asset categories. The 2028 US presidential election is another potential acceleration point. Regardless of who wins, the new administration will need to deal with the debt ceiling, potentially implement new fiscal policies, and address the growing instability in the financial system. Elections create political uncertainty, which typically accelerates capital flight and currency diversification as international investors reduce their exposure to political risk. But here's the key insight. You don't need to predict the exact moment of the reset to prepare for it. You just need to be aware that it's coming and start making incremental changes to your portfolio and life circumstances now. The preparation isn't a one-time action. It's a series of strategic adjustments over the next few years that gradually shift your wealth and risk exposure from assets vulnerable to the reset to assets that will thrive in it. This is actually good news because it means you have time. You don't need to panic and make rushed decisions today. What you need to do is develop a plan and execute it systematically. Move 10% of your financial assets into hard money and real assets each year. Build skills that will be valuable in a restructured economy. If you have a house with a mortgage, lock in low rates now if you haven't already. In a currency reset scenario, paying off debt with devalued currency is actually advantageous. If you have significant income in the US, start thinking about ways to diversify income sources and possibly geographic location. The people who suffer most in resets are those who do nothing and hope for the best. The people who do fine are those who make reasonable preparations. The people who actually prosper are those who understand the pattern and position themselves specifically for it. The question for you is, which group will you be in? The timeline is clear enough that meaningful preparation is possible. The only question is whether you'll take it seriously. The economic reset isn't just a financial event. It's fundamentally a geopolitical realignment that will reshape which nations are economically powerful and which are economically marginalized. Understanding who will be positioned advantageously in the post-reset world is crucial because it tells you where to direct your capital and attention. The United States, which has dominated the global economy since World War II, will emerge from the reset in a diminished position. This does not mean America collapses or becomes a third world nation, but it does mean that American exceptionalism and American financial dominance will no longer be as absolute. The reasons are structural and inevitable. The U.S. has been living beyond its means for decades, accumulating massive deficits and exporting its inflation to the rest of the world through dollar dominance. That era is ending. As the dollar loses reserve status, the U.S. government's ability to borrow unlimited amounts and the Fed's ability to print currency will be significantly constrained. The U.S. will need to live within its actual means, which will require significant reductions in government spending or significant increases in taxation. The military, which has been funded at extraordinary levels, will face pressure to reduce spending. American consumers who have benefited enormously from cheap imported goods will face higher prices as import costs increase. The comfortable post-Cold War period of American unchallenged hegemony is ending. China, by contrast, is positioned to emerge from the reset as the largest economic power. China has been deliberately reducing its dependence on the dollar and building alternatives. China has massive commodity reserves and strategic stockpiles. China has enormous productive capacity. China has a real manufacturing base, unlike the United States, which has largely offshored manufacturing. China's primary vulnerability is that it also has significant debt and an aging population, but China's authoritarian government can implement painful adjustments much more quickly than democratic governments can. China can force currency revaluations, mandate capital controls, restructure industries, and implement austerity measures without the political constraints that democracies face. This ability to execute difficult decisions quickly is actually an advantage during resets. Europe is positioned to muddle through but emerge somewhat weakened. Europe has been dependent on cheap Russian energy and China as a manufacturing partner, and both of those relationships are being disrupted. Europe's governments are heavily indebted, Europe's demographics are even worse than America's, and Europe's political system is becoming increasingly fragmented. However, Europe has significant strengths: massive amounts of productive capital, strong engineering and manufacturing traditions, well-educated populations, and reasonable social institutions. Europe will likely experience significant stress during the reset, but will ultimately stabilize in a secondary but still meaningful position. India is positioned to be a major winner of the reset. India has a young and growing population, which is the opposite of most developed nations. India has been deliberately building alternatives to Western financial systems. India's government is starting to be recognized as a genuine peer to China in terms of geopolitical influence. India's manufacturing sector is expanding as companies move production out of China due to geopolitical tensions. India's position as a bridge between Western and Eastern systems gives it strategic leverage. In the post-reset world, India could emerge as the primary manufacturing hub for a significant portion of the global economy. Commodity exporting nations are positioned to do very well during the reset, specifically those with governance structures that can actually leverage their resources effectively. Countries with oil reserves, rare earth minerals, agricultural capacity, or other strategic commodities become more powerful as commodity prices rise. However, this only benefits the nation if the government is organized enough to actually capture that wealth and invest it productively, rather than allowing it to be extracted by foreign companies and corrupt local elites. But here's the most important insight. At an individual level, it's not your country that determines your prosperity in a reset. It's your personal positioning. An American who understood the pattern and positioned themselves accordingly will be wealthier during the reset than a Chinese citizen who didn't prepare. A Brazilian farmer with real productive capacity will be wealthier than a Japanese financial engineer. The reset reshuffles global power, but it also reshuffles individual wealth within each nation. The winners are those who position themselves correctly, regardless of their passport. The losers are those who hold the wrong assets, regardless of their country's overall geopolitical position. This is actually the most empowering aspect of understanding the reset. You can't control whether your country wins or loses geopolitically, but you absolutely can control your individual positioning. You can shift your assets. You can develop skills that will be valuable. You can build relationships and networks that will have value in the new system. You can position your investments geographically and in asset classes that will appreciate. Your personal agency is real, and it's substantial. Understanding that a reset is coming is valuable knowledge, but knowledge without action is just interesting gossip. What actually matters is what you do with this information. So let me give you a specific, actionable plan that you can implement starting today. First, assess your current vulnerability. Make a detailed list of every asset you own, including real estate, stocks, bonds, cash, cryptocurrency, business interests, and anything else of value. Then categorize each asset based on how vulnerable it is to the reset. Bonds and cash in dollars are highly vulnerable. Financial stocks and real estate in declining urban areas are moderately vulnerable. Companies with real cash flows and hard assets like commodity stocks are moderately protected. Physical gold, land with productive capacity, and real estate in areas with strong fundamentals are well protected. Calculate what percentage of your net worth is in each vulnerability category. Most people who do this exercise discover they're extremely concentrated in vulnerable assets, which is why they don't have a plan. They're unconsciously hoping the reset doesn't happen. Second, start the reallocation process. The key word here is start. You don't need to do this overnight. But every month, allocate a portion of new savings and, if possible, a portion of existing holdings into more reset-resistant assets. A reasonable target is 10-20% of your net worth in hard money and hard assets. Gold, silver, possibly some cryptocurrency like Bitcoin, which can't be debased by any government. Another 10-20% in real estate with strong fundamentals. Another 10-20% in dividend-paying stocks that actually generate cash flow. Another 10% in commodities or commodity-producing companies. The remaining 40-60% can stay in more traditional investments, but at least you're not completely concentrated in vulnerable assets. Third, build productive capacity. This is the most underrated but also most valuable preparation. If you have an opportunity to develop a skill, start a business, or invest in a productive enterprise that generates real cash flow, do it. If you're currently employed but unhappy, start thinking about transitioning to something more resilient. If you have capital, consider investing in real businesses, actual companies that produce goods and services, rather than financial instruments. If you're willing to take significant risk and effort, agricultural production, energy production, or manufacturing are likely to be extremely profitable in the post-reset world. Even smaller-scale versions like starting a consulting business, developing expertise in a valuable skill, or creating content that educates people about the reset itself. These are all forms of productive capacity that will be valuable. Fourth, establish geographic and currency diversification. Open a bank account in another country if you can. This isn't about hiding money or being paranoid. It's about insurance. If you have the means, invest in real estate in another country. If you're early in your career, consider whether you might want to work abroad for a few years to build international connections and possibly establish residency rights in another country. At a minimum, make sure that not all of your assets are in one jurisdiction, not all of your income is in dollars, and not all of your decisions are subject to one government. This is the position of people who've seen government instability before. They diversify their political risk. Fifth, educate yourself and your family. Read books about economic history, currency crises, and investment principles. Follow financial analysts who actually understand the structural issues. There are many who do, though they're often marginalized by mainstream financial media. Have serious conversations with your family about the possibility of reduced consumption, changed lifestyles, or different priorities if and when the reset occurs. The psychological preparation is just as important as the financial preparation because many people who understand the reset intellectually still panic and make bad decisions when they actually feel the loss happening. If your family is prepared psychologically, you're much more likely to make good decisions when emotions are highest. Sixth, protect your capital from taxes and government seizure. This isn't about illegal tax evasion. It's about legal tax efficiency and legitimate asset protection. Work with good accountants and attorneys to understand how to structure your assets in ways that minimize taxation and protect them from government seizure. Understand which assets have legal protections versus which ones are vulnerable. In many jurisdictions, primary residences have protection. In most jurisdictions, gold held in your personal possession can't be seized the way bank accounts can be. Understand these structures and use them legally. Finally, position yourself to help others. When the reset occurs, there will be genuine suffering for people who weren't prepared. But there will also be enormous opportunities for people who understood what was happening and positioned themselves correctly. You can position yourself not just to survive and prosper, but to actually build something valuable in the post-reset world. This isn't cynical, it's realistic. Every historical reset creates a new generation of wealthy people who captured opportunity at the right moment. The question isn't whether you'll have opportunities, the reset will create them. The question is whether you'll be positioned to recognize and capitalize on them. The bottom line is this: the reset is coming. It's not speculation or doom-mongering. It's the inevitable consequence of unsustainable debt levels, impossible demographics, structural currency weakening, and accelerating technological disruption. The timeline is measured in years, not decades. You have a window to prepare, but that window isn't infinite. The people who take action now will have options when the reset accelerates. The people who wait will be forced to make their decisions under pressure, at the worst possible prices, when everyone else is finally recognizing what's happening. Your choice is clear. Now the question is, what are you going to do about it?